Good day, fellow deal makers. Welcome to the Deal Scout. My name's Josh, and on this show, we scout out cool deals and have conversations with deal makers about deals. This is a show all about deals, ranging from, lemonade stands. We've interviewed people talking about that, all the way to special purpose acquisition companies and publicly traded companies and everything in between. So we wanted to have a conversation about this idea of selling businesses, investing in businesses. So we hit our marketplace and we found a cool group out of San Diego who's going to talk to you a little bit about this deal. So Channing, welcome to the show.
Yeah, thanks. Glad to be here.
Absolutely. So Channing, what's the name of your business?
We're objective, and we do investment banking and valuation work.
Okay. So investment banking, kind of give us an idea on what is investment banking.
So one of the things we did is we named the firm Objective, and it's based on a foundational belief we have that business owners should make decisions based on their personal objectives. And the way I think about it is, if you're CEO of a public company, your job is to show up every day and make money for the shareholders. Whereas if you're CEO or you run your own business, private company, which is most of our clients, your job is whatever your objectives with the company are, to grow it, to have a lifestyle business, to do this, to do that. And so that's sort of the foundational element and the types of companies that we work with. And then in terms of what investment banking does, which is what your question was, we basically work with business owners to help them run a process to sell their company so that they get the best price and terms.
Okay. Got it. All right. So, and you guys are located in San Diego. Kind of give us an idea on a day-to-day basis, Channing. Like, where do you put your focus?
So our firm has about 25 people, and we have two groups. We have a full service business appraisal group, and we have folks in Texas, Colorado, and in Southern California, both in Los Angeles and San Diego. Most of the folks at our firm are in San Diego. On a day-to-day basis, one of the things I love about the job, no 2 days are the same. So the typical day story could go in any number of different directions, but working with business owners, helping to negotiate their transactions, doing some fairly complex valuation projects, meeting with potential new clients, that's sort of a typical day.
Okay. Let's go back. Like, how did you get into this world, right? Investment banking, like when I went to college, there was only like a small little section about investment banking, and I didn't really understand private equity, investment banking, all in this different world. I grew up on a construction site. I didn't learn it till I was in my 30s and 40s, right? So kind of give us an idea of how did you get into the game?
So I was fortunate to go to a school where investment banks were recruiting at the school.
Cool.
So in high school and going to college, investment bank was like, investment what? I didn't really know what it was. And in college, a lot of my buddies that were a couple years older than me went into like strategy consulting and investment banking. Those were sort of the two hot fields where you could make a lot of money and work on interesting stuff and learn a lot. So that's the sort of direction I wanted to go with my career. So when I graduated from college, I worked at a strategy consulting firm for 2 years in New York City, and then got married and moved to Philadelphia because my wife was going to grad school there, and had to switch jobs. And just by luck, through a friend of a friend, got an interview at Legg Mason and got hired doing investment banking. And the first transaction I worked on was with a family owned company. And, we helped this family that had owned their business for 3 generations sell their company and really change their lives. And like, I immediately fell in love with it. I went from the strategy consulting business where we were working with Fortune 100 companies, helping some faceless, nameless shareholder make money or whatever, to working with a family where they were less sophisticated, weren't really prepared to do a transaction, didn't understand the process, where we could really roll up our sleeves and help them and make a difference. And so just through luck and happenstance, got into investment banking and kind of, fell in love with working with these business owners and families that are smart people that don't have the, Wall Street or finance sophistication. And that's sort of the short version of a long story.
So then how from New York to Philly to San Diego? How did that happen?
So my parents got divorced in the late '90s, and my dad moved to San Diego for work. And I don't know if you've ever spent Thanksgiving in Philadelphia or Ohio, where my wife's parents are from.
It's chilly.
But we did that a number of years. And then when my dad moved to San Diego, we came out here for Thanksgiving, and that set a whole process in motion. It was really enjoyable getting sunburnt over Thanksgiving instead of frostbite.
Yeah,
You know,
absolutely.
yeah.
So at Thanksgiving dinners, what is your favorite food that you eat in Thanksgiving?
Oh, um, that's everything. But the
You
I
didn't
actually
expect
had
that
dinner
question on a deal show, did you?
had dinner last night at a steak restaurant, and there was a sweet potato casserole, which
Mm,
was like incredible. So that's definitely going to be on the menu this year for Thanksgiving.
nice, nice. All right, so back to deals. You move out to San
Yeah.
Diego, and you started this firm how long ago?
So I moved to we my wife and I quit our jobs and sold our house and kind of packed up our stuff and moved to San Diego. For a whole series of ready to do some different things personally, et cetera. And after being in San Diego for a couple of years, I started an investment banking firm with a partner in 2004, 2005 timeframe. And we were pretty successful for a small firm here in San Diego. And then in 2008, when the economy crashed, we pivoted and built a business appraisal. I mean, there were no deals happening in 9 and 10 and 11. So we started doing appraisal work, and we built about a 25-person practice doing 500 appraisals a year. And I got bought out of that in 2013 and joined Objective in 2014. And fast, I guess that's like 8, 9 years now. We now have 25 people, and we're doing investment banking and business valuation.
Super cool. So in the process, 8, 9, and 10, 2008, 9, and 10, tough years, right? For deal
Yeah.
makers.
Yeah.
What did you do to keep the lights on? Like you built a appraisal practice, but how did you think to do that?
Yeah, super interesting and really lucky. My former partner came across this new type of valuation called 409A. And so and I know you didn't want me to talk about tax code,
Go
but
for it, man. Go for it. Let it rip.
but 409A was a new thing that came into being in the 2008 timeframe. And effectively what happened in the dot-com crash, companies like Enron, WorldCom, and Tyco, the executives took money out of those companies through deferred compensation plans as the companies were failing. Nobody liked that. So the IRS enacted this new tax code, Section 409A, which kind of dealt with deferred compensation plans and closing a lot of loopholes there. And so one of those things was requiring private companies to do formal evaluation work when they were granting stock options. And
Ah,
so we started having people like nobody wanted, none of these early stage venture backed companies that are bootstrapped wanted to spend money on valuation work when they didn't have to. But there was an IRS regulation that said they have to. It came into effect in 2008. And so that was a godsend for us because the deal market cratered and the IRS dropped this plum in our lap of forcing companies to spend money to do something we knew how to do. And so we started doing these 409A valuation projects. And I think our firm became the second largest provider of 409As in the country behind Silicon Valley Bank by 2012, 2013.
wow.
And so it turned out to be the mechanism that kept the lights on for us when the deal market um, became tough. And our firm in 2009, the lease at the office we were in was up, and the landlord wanted to raise our rent and ask us to sign personal guarantees and all this stuff, which was like just nuts during that time frame.
Yeah.
And so we moved into a house. We rented a house and we moved into a house. And we cut the size of our firm in half and just sort of struggled through 2009, like building up the valuation practice, waiting for the deal market to come back, and kind of just muddled our way through. But it was tough. It was a time that I would like to not repeat.
Yeah, I don't want to do that again.
No.
I would love to, hear your thoughts about where we are in an industry now. Are you seeing similar signs, or what do you see? We're recording this in 2022 in September.
It's really tough. It's really tough. We've had just an absolute roller coaster over the last 2 years. We had COVID hit. Both of our businesses dropped from February 2020 to May 2020, both of our businesses dropped by 50%. Um, and so, I like having lived through the 2008, 2009 thing, like I was like, hey, I've seen this movie before. We got to hunker down. And so we did, we didn't really do any layoffs. We were fortunate to get a PPP loan, but we did very significant pay cuts and had all these tough discussions with people on our team around like, hey,
Mm-hmm.
this is going to be a tough time. Like we're better off sticking together and, muddling through and coming out the other end stronger. And then by July and August 2020, the government stimulus kicked in. The government stimulus kicked in, and the Biden administration was talking about changing the capital gains tax. And so the combination of the government stimulus and this capital gains tax created probably the hottest and most robust M&A market we've seen in our lifetime. So most investment banking and professional service firms had a record year in 2021 with people racing to get their deals done to lock in a low capital gains tax rate. And then 2022 started off equally strong. And then the market crashed and, interest rates are going up and there's talk of inflation and a recession. And that happened in March through May, which really slowed things down. And then we've had the summer where, if you're a business owner and you own a really good company, in the March through May timeframe, given that it takes, 6 to 9 months to sell a company, you're not going to start a sale process into an uncertain market. So a lot of people were sitting on their hands. Then we've had summer break. And that I think this summer was the first summer that people have had in 3 years because of COVID. So
Yeah.
everybody's been on vacation. And what we're seeing right now that kids are back to school, we're starting to see things come to life again. So what I'm kind of seeing is I think things are going to go back to normal, 2017, 2018 levels, like a good normal market, but not crazy robust. And then the second thing we're seeing is private equity and public companies have more capital available than they've ever had. And so what we've seen, and we saw this in 2020, and we're seeing it again, is in an environment where there's less deal flow, the fact that there's so much demand for deals is propping up valuations, I think, a little bit higher than they otherwise would be. And I'm hearing from my friends at private equity firms that in certain industry sectors, they're still paying the same prices they were paying in 2021, even though the market's down. And then, there are some other sectors, particularly in consumer facing, where there are concerns about recession, interest rates, consumer confidence, et cetera, where things appear to be slowing down a little bit. But by no means do I feel like we're going into the same like winter that we went into in 2010. So I know that was a long-winded thing, but that's kind of what we're seeing.
Super interesting. How do you feel like the baby boomer and silver tsunamis, seller tsunami, how do you think that plays into place? Because I mean, poor baby boomers, right? Like they built this family business all their life. They're about to sell, they're getting ready, and then COVID hits, right? Like, how do you think that affects
Yeah.
these numbers in this
Yeah,
roller
one
coaster?
of the things is as we think about our business, both our valuation practice and our investment banking practice, a lot of the work we do is driven by mergers and acquisitions work, and so we've purposely focused on sort of what I would call the lower middle market, which is a very large market and it's underserved. The bigger kind of household name firms, either in valuation or investment banking, are trying to work on the bigger deals and the more high profile things. And so we're sort of working like one notch below that in what I would call the lower middle market. I feel like there's a massive tailwind with the baby boomers and the demographics of business ownership. Just from a demographic perspective, there's a lot of people that are, aging and facing retirement that need to do some kind of transition with their business. A lot of them will do a sale, and then it feels like the younger generations are not as entrepreneurial, and possibly a little bit more risk averse and lifestyle focused. So they're not as much stepping up into business ownership. So I think it's gonna lead to, a pretty stable M&A, mergers and acquisitions, business sale market, what have you, over the next decade or two. But I guess time will tell.
Yeah, man. Let's do this. Let's say you were in the business you're in now doing the work that you're doing, and you had an opportunity to go back in time to 2000, you could either choose 2000 like 6-ish or 2012-ish and do something with the work that you do now. What would you choose, and what would you do differently to take a hold of the market?
Oh, that's really interesting. There's a trend in our industry towards industry specialization,
Hmm.
which we've been putting a ton of work into over the last 5 years, in terms of building specific industry expertise. If I could go back to 2006, I would have started that process much earlier, because I think that's sort of where the world is moving.
Yeah.
A lot of times when we meet a potential business owner that needs help with either a valuation or a sale, or we even meet a referral partner that needs help with either of those, one of the first questions they're asking us is like, hey, what's your industry expertise? Where in 1996, 1995, when I started in this business, I didn't get that question very often. Now we get it every time. And
Yeah.
so I think this, like, if I could go back and do it over again, starting that specialization process earlier is something that I'd go back and do.
All right, let's play a game. I'm going to name a time period. And if you don't know, you could just say, I don't know, pass, right? I'm
Yeah.
going to name a time frame. And during that time frame, you get to choose your specialization. Like you're the number one company in the area that focuses on this M&A wise. Okay. Like you're the best business valuation, M&A,
Yep.
investment banking. You're the best. 1995-ish. What would you specialize?
Uh, the, Anything related to the internet.
Yeah. Internet boobs.
Right.
2005.
So across this entire time frame, a space that I'm really interested in is companies that provide services and software into life sciences. That's been a very stable. Growing market, and there's been just a massive technology revolution over the last 20, 25 years in that space, with the mapping of the human genome, specialized medicine, technology coming into healthcare, et cetera, et cetera, et cetera. And so that's a space through all time that's been very, very robust.
Yeah.
And that's sort of it. It hasn't had a lot of the ups and downs that some of the other spaces have. Like 1995, if you specialize in the internet, in 2001, you're living under a bridge eating ramen, because there's nothing going on in that space. And so trying to pick a space that stands the test of time, I think is the trick.
Yeah, super cool. One more part of this game. Let's just say you were able to go to, you could go back to maybe January of 2020 with some foreknowledge of what was about to happen. All right, so you and I get to time travel back to January
Yeah.
2020 and be like, Shannon, let me give you a piece of advice. Something's major about to change. What would you do?
That's so interesting, and we've had a number of discussions about, because this year we've had a big stock market crash or stock market reduction, inflation, interest rates are changing, and so I'm trying to go back in time to, what was I hearing in January through March 2020 when the dot-com bubble was at its height? What am I hearing now, and how do I think about that? How do I think about that going forward? So we've been talking a lot about that, trying to figure out what moves to make in this like tricky market.
Yeah.
So it's super interesting that you asked that question. Um, I I don't know what the answer is, but during that time frame, a bunch of my buddies and I set up all of these online brokerage accounts, and we were buying IPOs.
Yeah. Yeah.
And we turned a small amount of money into a large amount of money. And I wish I had stopped doing that in January, because from January to March, that's when the institutional investors stopped investing,
Yeah.
and the retail investors got bigger and bigger allocations in these IPOs, which none of them worked out well. So I turned what was for me at the time a large amount of money into a small amount of money from January to June 2020.
Yeah.
So I wish I had sort of seen that, seen that coming, but lesson learned.
Yeah, you can't do anything. Now as deal
Yeah.
makers, right? Like you've been through early 2000s, the end of 2000, 9-ish is when it really
Yeah.
got crazy for us. And then now, so you've seen three major economic changes in the United States. As you go across that, one of the things that you guys specialize in is how much is this thing worth, right? I'm sitting on a business. How much is it worth, right? What makes a business valuable
You,
across the board?
it's interesting that you bring that up. We had an experience with a client. He's call it mid 50s, having some health problems. Decided to sell his company, and we went. This is in 2019. We went through the process, got a good offer in late 2019, and it met the client's objectives in terms of like enough money in the bank after tax to never have to work again, et cetera, et cetera, et cetera. But working with our client, we kept negotiating for more and for more and for more, which we did. We improved the deal quite a bit, and then we signed a letter of intent like March 8th, 2020, the week before the shutdown.
Wow.
Then COVID happened, and that sector kind of no M&As happening, so the whole deal got put on hold. And fast forward 2 years, we wound up closing this deal this year at a fraction of the price that it was on the market 2 years ago.
Yeah.
And so and I've seen this pattern. I have many stories in this, which I won't bore you with, but I've seen this pattern many, many times. And one of the things that I often think about in advising clients is, once you get to a number that changes your life, like stop wasting time screwing around for the extra because you don't know what tomorrow is going to bring. And we have all these, over 25 years of working, we have all these examples of, one day the dot-com companies were having money thrown at them. The next day, the ones that raised money before March 18th, 2000, had staying power, and the ones that tried to negotiate that extra nickel, they're all gone. And mortgage crisis. I mean, it's happened over and over and over again. And so this kind of pigs get slaughtered saying, really resonates with me, and that's something that we try to talk to our clients about a lot. The question you asked about what makes a company valuable is super interesting, and it differs by industry sector. And there's kind of a checklist we go through in looking at and thinking about that, with our clients. And you don't need me here to tell you that stronger revenue growth or higher EBITDA or better margins makes a company more valuable. I mean, that's like, everybody knows that at this point. But there are a lot of subtleties and nuances in the value driver thing that I think are interesting and would be worth talking about.
Yeah. Let's do that. Let's go through some of the, if you would say here are the three main key factors on getting a better valuation or a higher multiple, like pay attention to this. And let's choose an industry, right? So choose your favorite industry because each industry might have its different nuances. But pick an industry, and then let's go through three key factors.
The one of the biggest factors is an external factor that, is largely out of a business owner's control and hardest to predict, but it's the industry and the market cycle. And just an example, in the late 90s, I worked on a project where we sold a commercial printing company. And at that time, the printing industry still existed. People still read, public companies were still publishing catalogs, and there was a lot of high-end printing going on. And there were 7 or 8 public companies that were doing a consolidation. And so we had this commercial printing business that was like 100 million in revenue that we sold. We got 8 offers from the 8 public companies that were at that time doing the consolidation, and got them to negotiate against each other and sold that company for a premium. Fast forward 15 years later, worked with a printing company in the Bay Area whose clients were household name Bay Area companies, Google, Facebook, Cisco, et cetera, et cetera, et cetera. Amazing cutting edge technology. We couldn't find buyers interested because the consolidation in the printing industry had happened. Printing was becoming more and more commoditized, et cetera, et cetera, et cetera. So a better company 20 years later was not saleable at any reasonable price than 20 years before. purely because of industry and market cycle. So that's something that we spend a lot of time talking to business owners about is, understanding where your particular niche is, what the drivers are, what's going on in M&A and valuation, and just thinking about what's likely to happen over the next 5, 10, 15, 20 years, and thinking through that. So that's one of the bigger drivers. And
Yeah.
I mean, we could spend the rest of the hour talking about examples in different industries where, particular software companies have sold for 50 times revenue at one point. Now they sell for 2 times revenue, et cetera, et cetera, et cetera. But the industry and market cycle is one of the big ones. The second one is not necessarily purely valuation, but it's a salability factor, and it's engineering risks out of the business. So having a management team, and being sure the business is transferable to a buyer. If the business has a key individual, a key customer, a
Yeah.
key vendor, or something like that, and there's one or two kind of key relationships that are important, it's very hard to sell the business at all, much less sell it for a premium, because a buyer doesn't, there's a lot of risk on the buyer. So really stepping back and making sure the business is transferable, and engineering out key risk factors, key risk factors in the business. And we've seen them with key salespeople, key customers, key vendors,
Key founder.
intellectual property licensing agreements, partnership agreements, et cetera, et cetera, et cetera. So stepping back and understanding what those risk points are and engineering them out.
Yeah.
Most business owners that we've worked with that have these types of risks it's like the frog in the pot. They get comfortable with it over 20 to 25 years. They have a very good relationship with whatever the risk is, and they make it work. But then when it comes time to have a buyer write them a big check, buyer doesn't get comfortable that they can transition that relationship.
Mm-hmm.
And so that's the second biggest value driver we see. And then the third one is, business owners often have trouble clearly articulating what their difference is from the competition and why their customers hire them. And the more clear you can go to a buyer with, this is who we are and why we're special, and why when you own us, you can continue to have a really special asset. The more you can articulate that and have it be real and have it show up through all of the processes and systems in the company, that's another very significant value driver. And so those are, when we are working on either a valuation project or with a business owner that wants to sell their company, those are some of the things we look at to try to really, to really understand. And when you're selling a company, you really want to tell the story around those things. Those things. Hey, the industry is ripe. There's a tailwind. There are no risks with this business. The customer base is diversified. The employee base is diversified. Vendor base, et cetera, et cetera, et cetera. And by the way, this is a really special company. You couldn't replicate this on your own. You have to own this. And so really coming up with that sort of value story and understanding it is really a key. I mean, that's really sort of a key value driver, as I see it. And then, there's a bunch of other things that everybody talks about in terms of like EBITDA margins and EBITDA growth rates and multiples and stuff like that, that are, more basic blocking and tackling that everybody understands. But there's a lot of intangibles that go into creating a premium valuation for a company.
Yeah. So good. So the way I hear things, right? A hungry market, right? Like, what does the market really, really want? Alex Hormozy writes about this in his book. He says, like, you could have the best hot dog, you could have all the stuff, but a hungry market is the best thing to have. Um, the transferable business, the sellability, engineering the risk out of the business, it's awesome. And that is for us, for me right now, for our PR firm, it's mostly stacked around me. So it's very, we're working heavily consultants and such like that to create a transferable business in the future. And then the value proposition, the competitive advantage, like what makes this unique that you can't build it, you have to buy it, right? Like that is so good. Shannon, that's awesome. Great way to encapsulate, the value drivers in a business. Um, I love this, and I want to talk to you about this for deal makers out there, right? Like, there's a lot of deal makers who want to squeeze as much as they can out of the deal. They want to get as much meat off the bone, but sometimes when they do that, there's that saying that you were mentioning. Pigs get fat, hogs get slaughtered. There's something when you keep on forcing a deal that it just might dry up, disappear, and dissolve, whatever. How do you know as a deal maker when the deal's good enough to say yes?
It's really interesting. When I started my first firm back in 2005, our first client was a gentleman who was in his late 70s, and we were helping him sell his company. And it was a very complex process, and it was the first time in my professional career that I was the one leading the charge on the deal. So very stressful for me.
Yeah.
And like every transaction, we get down to the end where the buyer is basically, my rule of thumb is there's always like 10% of the purchase price being negotiated or more up until the last minute. And so we're in the heat of battle. There's a potential environmental liability that's getting negotiated. There's like, they don't think the EBITDA that we presented was correct, and a whole host of other issues. And my client kind of was like, hey, no one's happy. I think it's time to compromise and get this deal done. And so I think in every deal, when you're dealing with $100 million deal or $50 million deal or whatever, there's enough money at stake that you kind of get to this point where there's a feeling that it's time to stop pushing and get this done because the other side's getting ready to walk away. And it almost always gets pushed to that. It almost always gets pushed, to that point.
Yeah.
And that's just sort of the way it is. And I think sort of human psychology, at least on our side, when we're typically representing a seller, I think the human psychology is like, hey, I need to know I've put my life's work into this company or this asset. I need to know I'm getting the best or close to the best. And the only way I know is if I push so hard, the other side's getting ready to walk away.
Yeah.
So that's kind of what we typically see.
Yeah.
Um, it's definitely an art, and I think it definitely helps to have a good attorney and a good advisor that doesn't get all emotionally wrapped up in the situation. Because as a seller or as a buyer, it's easy to get emotionally wrapped up, say the wrong thing, make a rash decision, something like that, and it's easy to kill a perfectly good deal with a well-timed emotional outburst or a poorly timed emotional outburst. So
Yeah.
I think the advisors earn their keep sort of in that, on the goal line, so to speak.
Yeah. So think about it this way. That guy, 70 years old, he was probably in the business for 40 years, right? 30, 40, 50 years, right? How many businesses has he sold? Maybe one,
One. Yeah.
maybe two, right?
Yeah.
And I see this happen often, right? You're so tied to it and you're just like, what's my life going to look like afterwards? What's my identity going to be? This is my baby. I built this, sent my kids through college, whatever the case may be. And you're emotionally attached to the deal. And if you don't get exactly what you want, even more than what you think you want, you're going to blow it up.
Exactly.
Have you seen that happen a few times?
For sure. I mean, we've seen people go right to the end and then decide not to sell their company. And I think it's largely tied to it's somewhat tied to what you just said. They don't understand what's next for them.
Yeah.
And so if what we've seen as a business owner, if they don't have sort of the personal objectives well understood, going back to what I said at the beginning, um, it's harder to make that decision about selling the company because there's a financial element, there's a legacy element, and there's a personal element, and really all three of those need to line up for someone to sign on the dotted line. And if they don't line up, they shouldn't sign on the dotted line because they don't know what they want, and they don't know what they want, and they're likely to be disappointed.
Yeah.
And you can't, if you sell your company, you can't, it's hard to recreate that or get it back.
I find that the fear that a lot of business owners right before an exit, right, is what if I'm not getting as much? This idea of I'm owed more, or there might be more out there for me. Um, I find that that creates unrealistic expectations, or it has the potential to, right? There might be more, or they come out with like, "Hey, what do you want for this?" and they pull a number out, out of their hat somewhere. Like, how do you go about looking at here's actual value? This is actually what it's worth, in our opinion. Like, how do you come at that? And then how do you combat it when they're like, it's worth way more than that? How do you work through that?
Um, how much time do you have to answer this one? um,
That's your
I
business,
have,
right? Like
I
that's
have
the
a
whole
story.
thing.
I have a story. So
Yeah.
I was hired to sell this company, and the guy that owned it was a passive owner, and he had a general manager working for him who was 65. And so the general manager wanted to retire, and the general manager wanted to retire, and he needed to sell the business to provide retirement
Mm-hmm.
for the general manager. And so we go through the process. We talk to over 100 buyers, like every company in their industry, private equity firms, this one, that one. And, at the end of the day, we wound up with 4 offers. And there were some issues with this business in that the general manager who wanted to retire had key relationships with the 3 largest customers. And the general manager was a little bit of a difficult personality, and so he turned a lot of the buyers off. And so we wound up with 3 offers that were not great offers. However, they were all fairly similar. And so, after 6 to 9 months of working on this, a client calls me and he's like, "Hey, Channing, I've decided not to sell my company. The offers just aren't good enough." And I was like, "Well, hang on a second. I put like 9 months of my life into this.
Yeah.
Um, let's go have a cup of coffee." And so we had coffee the next morning, and it was like, "Steve, this is what you said you wanted when you hired me. You said you didn't need the money, you wanted to take care of your general manager, and that you wanted to have more free time so you could work on a family business that you wanted to start. Near as I can tell, like, I'm not going to sit here and tell you the offers are good. In fact, they're lower than I thought we were going to get, and I agree with that. However, near as I can tell, this deal checks all the boxes of what you said was important to you. And if you don't do this deal, there's no other buyer. I mean, we've talked to every buyer. There's no other buyer out there that's going to pay you more. So if you don't do this deal, you're going to have to fire the general manager that you want to take care of and work in this business and improve the things that are wrong with it, which is going to take you 3 to 5 years. It might work, it might not. It might work, it might not. It might work, it might not. And so that's sort of your decision, is like, do you do a deal that's less than you wanted, that checks all the boxes of what you said you wanted, or do you go back to work and improve the value? And so he ultimately decided to sell the company, but we changed the deal so that he retained some ownership with the new buyer, and it's worked out incredibly well. He's captured the value over time and accomplished all of his personal objectives. But the reason I tell you that story is the best way to put a business owner in a position to make a good decision is to run a market process so they clearly understand what their alternatives are. Like, I think we're very, very smart when it comes to valuing a company. We've done, we've worked on, as a group at our firm, we've worked on thousands of transactions and tens of thousands of valuations. Like, we're really smart when it comes to valuing a company, but like the theoretical valuation of, X times Y EBITDA is one thing. And usually it's directionally correct. But if you run a disciplined, well thought out market process, you're now educated on, here's what my options are today, here's what it's worth today. And if I don't like that, here's my roadmap to fix it. And so I think this process that we run in terms of educating ourselves and our client on the market is really a key factor in helping them make a good decision. And we've had situations where we take a company to market and the numbers come out different than what we thought for a variety of reasons. and our client decides not to sell, and that's fine. We help them make a really good, a really good market-based or fact-based decision. And that, that at the end of the day, that's all you can do for your clients, is help them make the best decision possible.
Yeah, I've heard, what is this worth? What someone's willing to pay for it, right?
Yeah.
And a way to do that, the way to figure that out is multiple offers, running through your market process, talking with people, putting it, packaging it well.
Yeah.
Now, when it comes to, all right, maybe now's not the time to sell. All right, so you and I are working together on a big deal, and we look at it, and you're like, Josh, sorry to tell you, dude, things not ready to sell. Do these few things over the next year or two, and then you're going to be much happier with the outcome. Do you come across those kind of opportunities in your business where that just needs some nurturing and care?
Yeah, and I think I touched on this earlier. For a business owner to want to sell their company, they need to understand like what their number is. Hey,
Yeah.
I own this company. I own this company. I'm making money every year. Like, I'm going to trade that for cash in my bank account or cash in my stock portfolio or whatever. Like, how much do I need to trade it for to support the lifestyle I want? So like, they need to understand personally how much they need. That's actually fairly complex to figure out.
Yeah.
And so, we love to see business owners work with a financial planner or something to know the answer to that. We don't really do that stuff. We're more focused on the business. And then, we do a lot of work with business owners. It's like, hey, you're in this rapid growth cycle. Your industry has these characteristics. Like, if you hold on to this and you change, these couple things over the next 3 years, you have the potential to triple the value, and
Nice.
your risk of losing value is quite low. Like, why would you sell? Like, why would you sell today? It seems like hanging on to it and, continuing to grow makes sense. And then the other thing, the other thing that I love about that situation is we can start to give them advice and help them build the team so that they're truly ready to sell. Because a buyer is going to come along and there's like 7 or 8 key streams of due diligence that they're going to do. And so if a business owner can be ready with to conquer all 7 or 8 key streams of due diligence, it makes the process a hell of a lot easier. And so this sort of, in our business, we're not necessarily consulting with companies on a monthly basis or weekly basis, helping them get ready. But, we do a lot of work with people to create a relationship where we help define the roadmap, and have had a lot of success with that over the
Yeah.
years.
Awesome, man. So for groups that want to connect with you, what does the perfect deal look like for you? So someone's listening in, they go, "Hey, man, that's actually my business. I want to go have a chat with Shannon."
I think it's two. I mean, I think it's two things. I think one is someone who's really curious about what their company's worth and what it takes to have it be ready to sell. Our appraisal practice has a kind of process that we follow. We call kind of an exit gap analysis, if you will. What's it worth today? And then, and the deliverable is, what is it worth today? What are the value drivers, and what is like a prioritized list of things to work on to improve the value? So we do that with a broad range of companies. Most of the companies where our expertise falls are worth kind of 5 to 10 million at the low end, up to 150 million at the high end. That's sort of one area for people listening that I think we can add a lot of value to and help with. And then the second one is for people that are thinking about selling their company, whether they've got a couple buyers interested, they want to understand the process. Get smarter about, should I sell now? Should I sell in the future? I mean, those are all things. Those are all things that we can help with.
Super cool. Um, Best deal, worst deal ever.
Um, the best deal. We just have so many great stories of helping people. But one of the deals that we worked on a couple of years ago was a company that was providing kind of data services to pharma companies, and there were 3 owners that were equal partners, and they were approached by a buyer in 2015, and the offer was relatively low, and it was some cash up front and an earnout, et cetera. And I met with the CEO, and it's like, do you have audited financials? No. Do you do this? No. Do you do this? No. Do you do, like, every single question? The answer was no. I mean, they just, like, no succession plan, no financial projections, like, nothing. And so over the next 4 years, they worked on a lot of the stuff. And I met with them a few times over the years, and they came back to us with succession plan, audited financials, financial projections. Like, the business was dialed in, and we sold it for them for 5 times in cash what their first crappy offer was 4 years ago. So that was like, that was just super rewarding to, to help them with that. I mean, they did much of the hard work in terms of improving the business.
Sure. Yeah.
But that was a lot of fun. The worst deals ever. I don't know if we've really had a bad deal. The hardest ones are when we have international buyers.
Oh yeah.
And so we've had the opportunity to sell U.S. based companies to companies in Asia and companies in India, and dealing with the cultural differences and the time change and the different laws and the different accounting rules. And it's really, it's fun, but it's really complex and tricky to navigate that. And, setting your alarm for 2:30 in the morning to get up and do a conference call to talk to an attorney in Singapore is not my idea of fun, but we've done it, and really help people doing that. And so those are the hardest ones.
Yeah.
For us.
Awesome. During this interview, there's probably questions that I should have asked you, at least pertaining to the topics of the conversation today. There's a question I should have asked you that I screwed up and did not ask you. What is that question?
I think the one question is, like, what are the issues facing business owners as they think about how to prepare to sell their company. I mean, I think one of the things that I've seen over the years, across most, if not all, the transactions I've worked on, is I feel like business owners, in particular, the ones who have built his or her company over a long period of time, and this is their first transaction, I feel like they don't take the time and educate themselves to truly understand the process and truly be prepared. There's personal planning in terms of what are they going to do, how much money do they need. There's tax planning in terms of making sure they optimize their taxes. They optimize the taxes for their family, the generational and estate taxes. There's personal issues in terms of, like, hey, I'm going from CEO to seventh in line at Starbucks, like, and then there's the business things, just the whole host of business things. But the common ones are underinvestment in their finance team, underinvestment in their reporting systems, incomplete management team that won't show well during the process, and then not necessarily having a well-defined and articulated strategic plan and financial projections. I mean, those are some of the key areas where if you don't have that, it's harder for an investment bank and a set of advisors to help you really maximize the value. So that's a whole sort of this preparation and appreciation for how complex and difficult it is to sell a company for a premium. Is one question that one thing I love talking about and educating business owners on. And then the second one is, a lot of people come to us with a buyer already interested, and they've shared poorly thought out and partial data, and they've really set themselves up to fail, because once a buyer anchors on a certain deal structure or price, totally, it's hard to put the toothpaste back in the tube. And it's also then hard to run a full auction process, because you got one buyer interested that's not going to hang around forever while you do the auction process. And so a lot of times I think we feel like we have one hand tied behind our back in terms of not being able to truly maximize the value. However, we can still help. We can still help in those situations, but it's not necessarily the most ideal scenario in many cases.
How long should someone connect with you? Like, is it the first, time that it pops in their head is like, hey, I might sell this one day. They should probably start having chats with you, or is there a time frame? Like, what is that perfect time to reach out?
I mean, I think that um, it's never too soon. I think it's never too soon to connect and be ready. And I think that the companies, going back to some of the value drivers we talked about, the external one in terms of the industry and the market cycle, being ready when your phone rings, when the right buyer knocks on your door and says they're interested, truly being ready for that is that's where like the magic happens and people can sell for a premium. So it's never too soon to understand, what pieces need to be put in place for an exit, what the process is. When I do get that call and I'm ready, what is my team going to look like? Who's my CPA, who's my estate planner, who's my financial planner, investment banker, attorney, et cetera, et cetera, et cetera, to have everything ready to go so you can mobilize the team when you're ready. That I think is really the best practice.
So let's do this, Shannon. If people are listening in, they've got a deal on the hook and they'd like you to take a look at it and maybe help them sell their business or put a value on it at least. What's a good place for people to connect with you and do a deal?
Yeah, my contact info is on our website. Feel free to pick up the phone or shoot me an email.
Cool. And it's objectivecp.com. Is that right?
Correct.
Cool.
Correct.
So let's do this, fellow deal makers. As always, reach out to our guests, say thanks for being on the show, find a way to connect with them and do a deal. That's the mission and purpose of the show, is to put deals and deal makers together. If you have a deal that you would like to talk about on this show, head over to thedealscout.com, fill out a quick form, and then maybe you could talk about your deal and your deal making journey on this show. Till then, we'll talk to you all on the next episode. See you
Cool.
guys.
Thanks for having me.
You're welcome, man. Good having you.